Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network. Before we get into today's show, there are a few things we have to go over. Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you'd get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program. Kate Campbell, welcome to this episode of the Australian Finance Podcast.
It is wonderful to be back, Owen, to talk about one of our favourite topics.
Yes, investing, how to be a better investor.
In 2023.
Yeah, so it's going to be a slightly shorter-ish episode where we give you some cold, hard facts about what goes into being a better investor if you've already made your first investment.
Yeah, because I know a lot of our listeners have been investing for a while now, so there's always that question of what's next? How can I improve? How do I level up? Which I hope we're going to dispel a little bit of that in this episode today.
Yeah, I think maybe 80, 90% of people that listen to our podcast now are investors, which is fantastic. It's what we've always wanted. So it's great to see. But there are a lot of things that can go wrong and you always want to get better. So how do you do that simply and kind of even with some of these things quickly? You can learn from our mistakes or our successes or others. And I think that's a better way to learn about investing. So where do we begin?
Well, the first one I think is super important to talk about is that we shouldn't be checking our brokerage account every day because it's not going to change things.
Yeah. So number one, don't log into your brokerage account each and every single day. Well, how often would you log into your brokerage account?
These days, it's probably once a month, maybe when I'm just updating things or making an investment or checking something for tax purposes.
Yeah. I remember when I started, I was doing it like every hour.
Yeah.
But literally, I would watch the share price of Telstra and I'd click refresh on my brokerage account. This is when I used CMC Markets, the brokerage platform. Don't use that anymore. And I would see the value of my Telstra investment go up and down and up and down. I was like, oh, I'm making money. Oh, I'm losing money.
It's so easy to fall into that trap, though, especially when you make your first investment because you want to check in and see, did you make the right call? But whether you made the right call investing in that ETF is not going to be determined in the next minute or two.
No, it's not. And I probably check mine every month or two because and you might think, people listening to this might think, well, aren't you like a professional investor? Yeah, but you don't need to log into your brokerage account to get information these days. You can go to a website called marketindex.com.au if you just want the announcements for your company. You can go to motleyfool.com.au also has the announcements page.
Stocklight? You still using that?
Yeah, the app sends me notifications when something like a piece of news comes out.
Even the AFR usually sends you a notification on my phone if there's something important happening.
Yeah. And you can, if you want actual company information, you can go direct to their website or the source that, other than Market Index for Australian shares, the thing that I use next after that most would be Ticker, TIKR, which we've spoken about briefly on the show before. There's a free version and a paid version. I've got the paid version, like $20, but I use that like every day. And you can use these tools to keep up to date with your portfolio. And the key thing is it stops you from going into your portfolio because if you see it go up and down,
I think that's the danger. If you are looking at your portfolio on a daily basis, it stops you thinking long term.
Yeah.
Like some people I talk to, they're completely fine looking at their portfolio every day and it doesn't impact them, or that's what they say. But I think for a lot of us, if we see red and green moving up and down on a daily basis, it's going to make us think a lot more short term and not think long term, which is the aim of the game here.
Yeah, it is. And that actually brings up another tip here, which is to have a plan, knowing that your plan may change. I think that's the part where people miss out is they do go into their brokerage account, but they haven't got a plan. If you've got your brokerage account and you check it every day, fair enough. Like people in retirement do this too with their super. If you are at that stage, it's okay because if you've got a plan, you know where you're heading. It's when people don't have a plan and they're checking their brokerage account. So the next tip is to have a plan, any plan really.
Yeah. And even if it's just getting the notes app out on your phone and writing down a few simple things about what you're invested in, what your why is. Is it for long-term wealth creation? Because that's a very different game to trying to make money overnight.
Yeah, if you're trading stocks, well, that's very different to being a long-term investor. When you're a long-term investor, you typically own shares or listed investment companies, LICs, or you own ETFs. Those are the typical things that our community owns. And I think depending on what you want to get out of it, I think that long-term investing is the only thing that really works. And one of the reasons I say that is because if you do get stuck down in day-to-day what's happening in your brokerage account, there's a lot of life passing you by, and it can be a very stressful thing. So figuring out what type of investing you want to do is really important. And then realizing that a lot of what we do in the stock market, we measure short-term, but we expect long-term. So what I mean by that is like we measure short-term returns, short-term results, even quarterly results from companies, but we want long-term returns. So where else in your life would you look at something each and every day and expect it to be a good thing over the long term? It doesn't always happen because what we tend to find is that our emotions are in the present moment and we make changes now. And if we don't have that North Star that we're moving to, it will change, it will pivot often. And like you said, Kate, it can just be an Apple Notes app, it can be a Google Doc, it could be one paragraph. That's it. Why are you investing?
I've seen some really cool plans created by members of our community, but it doesn't have to be complicated, even if it's just sort of like, what are some of the things that will stop you reaching your goal? That's sort of working backwards and going, well, if I don't invest enough each month, or if I stop paying attention to my spending and I just spend everything this year and don't put any money aside for my goals, or I check my portfolio too much and that causes me to make some decisions that might be good for short-term me but not long-term me.
Yeah, and a lot of times people think that their investment plan needs to be really complicated, really comprehensive. I would just say the number one thing is like, why are you investing? And for most of us, about 9 out of 10 probably 8 out of 10 in the Rask community, it's retirement. And with under that umbrella of retirement, it could be early retirement, it could be retirement on time. Financial independence,
of some sort.
Passive income is probably the other thing that's really popular. But passive income applies both now and in the future. And it's about like sowing the seeds for that growth over the long term. So then your portfolio in retirement or early retirement or throughout life can help sustain your lifestyle. And at the end of the day, if that's your plan, if your plan is literally, I want to have $500,000 in an investment portfolio in the next 20 years, it's very easy to work back from there. And what you'll probably find is that you don't want to be, if your goal is 500 grand, you don't want to be checking your brokerage account every day because you'd rather be working and earning more money to shovel into your brokerage account. Makes sense. So I think these two are kind of intertwined.
Yeah.
And
also on that
really
point
important
that it can change, because what you want today is probably going to be very different in 10 years. And you might be living in a new place, you might have a family, you might have completely different lifestyle priorities. So understanding that this is your plan now, it's working, it is a long-term plan, but you might have to change the way you invest because XYZ has changed. You might decide to focus on property and not shares, whatever happens, like just making sure it's flexible enough to accommodate your life.
Yeah. And folks that listen to the show know that I want to farm, you want a forest. Those are like very simple things, but they're big goals. But that is the why we're investing. So work back from that. How are you going to get to that why? We're going to need a certain amount of money. How much money is that broken down into yearly, monthly, whatever? So another thing that is really interesting, Kate, is diversification isn't just a numbers game. This is number 3. What does that mean?
I think a lot of us can fall into that trap that we just start investing in things and we just keep adding more and more different types of shares and ETFs to our portfolio. And you've talked about it before, being the idea of being a collector, where we just keep adding lots of small pieces of different things to our investment portfolio. And it sort of links back to that plan, because often at the start we don't have a plan. And so it's very easy. I've done that too, where you end up, especially with the fractional investing apps and micro investing apps, suddenly I had $50 in this share, $200 in this share, and it was kind of very hard to manage. And then you find out there's actually a lot of overlap with different things. So for example, you might have an ETF that invests in the largest US companies, which is, there's a lot of tech companies in there. And then you might have invested in a technology ETF, which has similar companies again. And then you might have gone and invested in some of your favorite tech companies. And you thought you were diversified because you had 10 plus different investments in that portfolio. But then when you had a look at it, you realize that most of my portfolio is just in large US technology stocks. And they're great, but I want to be diversified as part of my long-term investing goals. And this isn't quite diversification.
Yeah, and this is a problem that a lot of people face. They don't know how to compare ETFs. They don't know how to compare companies like stocks. So in finance terms, what we do is we measure something called the correlation. And this is, for anyone that's done statistics, you will know, it's just basically how two things move with each other. And if you end up with, say you have 3 different ETFs and they all have some Apple shares or some Google shares, the ETFs are just a measure of what's inside them. So they're all kind of going to be related to each other. So because if Apple falls in one, well, the Apple share price falls, they're going to fall in all. So what we try and do when we build portfolios is we try and find things that aren't correlated, like perfectly with each other. And it's that old, thing you sell. What is it? You sell umbrellas in the winter and you sell ice creams in the summer. Having 2 different things for different seasons means that if one part of your business is struggling, or if it rains today, you've got something to sell. But for us, when we look at ETFs, you have to pop the hood, see what's inside. You can look at a tool like Vanguard Fund Compare, which is a free tool for anyone to use. Just Google Vanguard Fund Compare. That shows you what's in the top 10. It also allows you to, not that many people would want to do this, but you can look at bond ETFs and these types of things in there. That's what we look at. And that's an easy way to do it. For anyone that's like an engineer or a maths whiz out there, you can go into a spreadsheet and just do a correlation between the share prices. That will tell you what you need to know. But at the end of the day, what we try and find are things that don't move together all the time. And because if one of those things goes down, we want the others to be stable. And people think, well, this just sounds like some fancy finance thing. But let me just give you an example. In your example, you said like you've got like the S&P 500 ETF, right, the US stocks. And let's say that you've also got a cash ETF. And you've got, this is not what I would do, but just as an example, you have 90% of your money in the S&P 500 and 10% in cash, right? Let's imagine that the US stock market falls 20%. You can then take that cash and put it in the ETF. And sure, you won't have cash for a moment, but what you will have is you will have invested at better prices. And I think that's the thing that people miss. They think, oh, I don't want to diversify. I don't want to do all that. Yeah, but you might get it wrong. Or you might get an opportunity to buy better in the future. And that's one of the ways we think about it. And finally, we've had some people write into us. They've got 50 shares, 30 ETFs. It's too many. You don't need that many. Like 5 to 10 ETFs is fine. That's enough.
And just think, if you have a look in your super fund, they've diversified for you. So if you log into your super account today and you see that you're in a balanced fund or a high growth fund, and then you go onto the product page and it will break down hopefully there'll be a pie chart. If they're old school, it might be a table, but it will actually say, oh, you've got X% in Australian companies and X% in US and this much in bonds. And that's an example of diversification. So your super funds already done their own research and decided this is what a diversified balanced portfolio looks like for you.
And I think if you just think of investing as the different like parts of your recipe, different things go together and they blend well together. They make things better. And if you just, like a lot of people that unfortunately, not necessarily in the Rask community, but in other communities I know, they might be like 100% shares or 100% in one stock. That is just a recipe for very, very, very dangerous results. It can work, but it can also mean that things go horribly wrong. So,
and a lot of people won't tell you when it doesn't work.
Yeah, they'll just leave the stock market and say it's like gambling, and then you ask them, and they'll be like, "Yeah, I had it in this one, speculative mining company." And you're like, well, is that representative of the entire stock market? Not really.
Number 3 was diversification isn't just a numbers game. There's more to it. All right. The fourth one I think is really important to talk about it is unless you really want it to be, don't make investing and managing your portfolio your hobby.
Why is that?
Because I think then we get stuck in that trap of continuously wanting to make changes to our portfolio. We can start fiddling with things even though we wanted to invest for the long term. And most of us aren't that great at investing in individual shares.
Yeah, it's fair. Most people aren't, to be honest. We see this on the Perla platform. Perla, sponsor of the show. Thank you very much. Perla, I think it was 87% of people on the Perla platform invested in ETFs. And I think I was talking to Ilan Israelstam, one of the co-founders of BetaShares recently in Sydney. And that's available on the Australian Investors podcast, if you're interested. But I was chatting to him, and he was saying that he believes that when they set out 10 years ago or whatever it was, that they saw a world in which everyone started with ETFs, and most people would finish there because that's all they need. It's like the old 80-20 rule. Like you get 80% of the reward for 20% of the effort. And I think it's probably even more like that. It's probably more like 10% of the effort for 90% of the reward. And a lot of people will be fine with that. Like we talk about building a core and a satellite portfolio, but we say start with the core, then the satellite, because...
And sometimes you can end with the core.
Yeah, that's it. You can start with the simple, low-cost, diversified things that you know work, or get someone to do it for you, frankly. Like you can just pay someone to do it for you and get on with life. But if you do want to go to the next level, you can. And this actually brings us into the fifth thing, not to jump to it too quickly, but you don't have to keep leveling up. That's number 5. You don't have to keep going. And I think these two are intertwined in that way. You don't have to turn investing into this thing that you do in the office for 5 hours a day. You simply do not need to do that. I don't do that when I go home, for example.
And I think it's also one of the things that if you haven't started investing can seem off-putting, because if you haven't and you're looking from the outside, I've spoken to many people who have this opinion that investing's a lot of work. It's going to consume their weekends. It's going to be really stressful. They're going to have to be watching news every day. And that's not that. Sometimes that can be what investing looks like, but it doesn't have to be. And it's not the case for most people.
No. I think even the people that sound the smartest and that do this a lot, I would guess and say that a lot of their returns aren't as good as just a simple ETF portfolio or a diversified portfolio. And so, sure, like we say, investing is a 3-year apprenticeship, but it doesn't need to be. Like it doesn't need to be. I think most people that listen to this show, Kate, like most of us here, we are interested. We are curious about how the world works. Like when we go to a cafe, we think, this is a really good business. This is really great. I love the coffee here. And look at that thing across the road. It doesn't sell that good of coffee and it's not that busy. And so we always are curious about why those things work. But it doesn't mean that we then need to go and translate that into investigating all of the cafes in the world and buying shares of Starbucks and doing all that sort of stuff. We don't have to.
Yeah. You just want to know enough to have a really simple, low-cost investment plan that works and it's going to help you reach your goals. You don't need to make it a hobby, a career. You don't need to spend hours and hours poring over different investment books and academic journals. Like that's not necessary for successful investing.
Yeah, it's not. It's not. But I would just maybe if I bring a counterpoint in here, I would say that a lot of people are curious about it and they want to do it, which is perfectly reasonable.
Yeah.
But just in the beginning, make it contained. Like have that as a smaller part of the portfolio. Like a lot of the people that I speak to that are more like in their 40s, 50s, 60s, 70s, this community probably have enough. Like they're on the right track. Even if they don't have it now, they're on the right track to where they want to be. But they love the idea of businesses solving problems, finding out what's the new technology or how to invest with a great founder or something like this. And that's really exciting to them. And they're really passionate and curious about how the world works. And they can do that. And you may be one of these people listening to this. You may be one of these people that are curious, but you don't have to go and try everything straight away. You can take your time. And that's why probably the first $100,000 that you save up and you build as part of your net wealth is probably going to be a function of how much you can save. And how much you can save is going to be a function of how much you earn and your spending habits. But as time goes on, you'll find that the next 100,000 is easier because you have the 100,000 growing in a sustainable way. And you'll get to a point where you're like, okay, now what else is there? And I think that's where a lot of people then go, okay, now I can build my satellite. Now I can do all this sort of stuff.
Yeah. I guess there's that temptation to jump into the satellite too early. Do you think?
Yeah, absolutely. Like people often ask, how much do I need before I start buying individual shares? And it's not necessarily about that because nowadays you can use a platform. Let's think of a platform like Raise. You can use a platform like Sharesies. You can use a platform like this that allow you to invest like a few dollars and you can buy individual shares, right? You can put $50 in Apple. You can put $10 in Cochlear, the implant maker. You can do all that sort of stuff, right?
Yeah.
And so I would say that it's more like a time thing. Like just listen to the podcast for 3 or 6 months, get a sense of what's out there. And then when you do invest, still keep putting money into your core and then start to slowly get used to the feeling of things going up and down. Because your core portfolio will rise and fall, for sure. But the difference is it will only probably fall 20% at most, 30% maybe, say, whereas a stock could fall 50% and it'd still be fine. You just bought it at the wrong time. And so I would, in the past, I've said people should probably get to about $20,000 invested. but that would depend. If you've got $20,000 and you never invested, I'd say start with the core and go from there. Back when I started investing, I feel old now, Kate. I didn't have the option. Like ETFs were around, but they weren't as prolific as they are today. So I started with Telstra, hence why I was looking at that. I started with NAB, these types of BHP, Rio Tinto, these boring blue chips. They were effectively my ETFs. But was that a good experience? Probably helped me learn. I probably put too much into them and I lost money because I was too anxious. If I was starting today, it would definitely be an ETF to start with. A share ETF, like a diversified one. Yeah, I think that would be the way I go. So just to recap these, Kate, if we may.
Yes.
5 tips to be a better investor. This is for someone that is already investing but maybe just getting into it. Is number 1, checking your brokerage account every day won't change the investment. It won't make a difference.
But it may change you for the worse. So potentially if you are struggling managing your emotions and you're looking at it every day and thinking, oh, what should I do? Should I change the plan? Maybe that's a good time to remove the app from your phone and just put a limit like once a week and then wean yourself off to once a month.
Yep, I like it. Number 2 was have a plan and knowing that your plan can change. It can be really simple, right?
Yep, make it as simple as possible. And I put some extra questions in the show notes as well that can give you some prompts when you're writing that plan down.
Yeah, like what does my portfolio look like right now? What is my long-term financial goal? Really simple prompts. It doesn't have to be complicated. You can just write them down, scribble them down on a envelope, back of an envelope, whatever you want to do. Number 3 was diversification isn't just about numbers. It's about so much more.
Yes, and it's important to know what's inside your ETFs because you might realize you have a bit of overlap.
Yeah, and even if you're thinking about diversification of your career, diversification of your income streams, diversification of your property, there's so many things that you can deflect some of the risk in a really easy way. News sources.
Diversification is like a pretty good strategy for most things.
In life, yeah. You get a broad kind of worldly understanding of how things are moving together. The next one was you don't have to make investing a hobby. Like you can just keep it simple.
Some people love learning about the world and individual companies, and other people just want to get on with all the other stuff in their lives and just have a simple plan that works. And you can do that, and that is perfectly okay.
Yeah, that is absolutely okay. And the final one is you don't have to keep leveling up. Like you don't have to be like Kate and I, where you listen to podcasts, you talk about investing, you talk about business, finance, whatever. You don't have to do that. Like we recognize that most people don't do that. They're probably the 80,000, 90,000 people that listen to this podcast occasionally probably would disagree with us a bit. They want to level up, but that's okay. You don't have to keep going. There is a point where you can reach and you're like, okay,
you don't need to keep finding a more complex investment option to add to your portfolio or a tax loophole. You can just keep things simple and that works. Simple works.
ETF in your core, diversify, build up from there. If you've got any other tips, you can let us know. If you listen on Spotify, for example, there's a bit of a feedback section there. You can share your thoughts and let us know what you think. We can turn that into an episode in the future, or you can write into us on the Rask websites or wherever you get your social media. Kate, it's a bit of fun. Thanks for joining me.
Thanks for listening, everyone.